Hello, everybody. Hello, clients and friends. It's summertime, and I'm in the office with a beautiful day. How do you like that? Anyway, for those few, I think pretty much everybody knows me, but in case you don't, I'm Mark Swingle, founder, principal, Westfield Financial Planning. We are an independent registered investment advisor located in downtown Westfield, New Jersey, across from beautiful Mindawaskan Park. It's my pleasure to present our half-year economic review. Knowledge is power. At our firm, we partner with clients and believe an educated client is our best client. When it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can better help them make an informed decision. So, equity markets, second quarter. Second quarter of 2023 continued to test even the most seasoned of investors. It was a quarter that included the U.S. reaching a debt ceiling agreement, the Federal Reserve slowing their aggressive interest rate hikes, and bank failure fears starting to subside. Equity markets continued to climb the proverbial wall of worry, with major indexes ending the quarter higher. The S&P 500 led by I'm going to get rid of my picture, you don't want to see that. S&P 500 led by a handful of large tech stocks rose 8.3% during the second quarter, logging its third straight quarterly gain. The S&P 500 closed the quarter at 4450, ending the first half of 2023 up 15.9% for its best half since 2019. The Dow Jones Industrial Average ended the quarter up 3.4%. So still with the S&P 500, led by outsized performance from mega cap growth stocks and the artificial intelligence or AI buzz, the S&P 500 likely began a new bull market in June, rising over 20% from its low in October 22. Keep in mind, there is no official definition of when a bull market begins, and this definition doesn't mean all losses have been erased. Despite this current new bull market consensus, many analysts are saying we are not yet out of the woods from a possible downturn. This caution is to be expected, as the next crisis du jour is always seemingly around the corner, and the market has historically eventually resumed its long-term upward trend. Oh, the debt ceiling, how I don't miss it. On June 1st, the U.S. Senate passed a major debt ceiling measure, increasing the government's debt ceiling and putting caps on federal spendings until January 2025. The United States government was facing a potential default on its obligations as a result of a political game of chicken. It was a toxic brew of politics and potential financial catastrophe. Ugh! We got a lot of calls from worried clients. The solution, averting the calamity, was the obvious to all, but no sure thing, bipartisan bill to raise the amount of money the government can borrow. Crisis averted once again. I am so happy I never went into politics. Inflation. In the second quarter, we saw an easing of inflation, thank goodness. According to the 12-month percentage change in the Consumer Price Index, in May 2023, prices increased by 4%, compared to 8.6% in May of 22. Similarly, in June of 2023 this year, prices increased by 3%. This compared to 9.1% of June of 2022. That means basically the rate has dropped by 2/3 since last June. Both numbers have gone a long way to calm the markets, and hopefully the Federal Reserve as well. Interest rates. In response to the slowing of inflation after a very aggressive 10 consecutive interest rate hikes, we saw a much anticipated pause in rate rises by the Fed in June. However, just yesterday, as expected, the Federal Reserve raised the federal fund rates by a quarter point to a target range of 5.25 to 5.5%. The current rate is the highest it has been in the last 22 years. Holy cow. Okay. So just looking at the various maturities and the Treasury yields comparison. As of June 30th, 5-year Treasuries yielded 4.1%, 4.13% rather. 10-year notes yielded 3.81. 20-year notes yielded 4.06. 30-year notes 3.85. Following yesterday's rate hike, since the increase was greatly anticipated by the market, the rates have mostly stayed steady. Treasury yields and the yield curve. So typically, long-term bonds have higher yields than short-term bonds. But as we can see on this chart, this is not currently the case. On the left side of the chart are short-term notes, 1 month, 2 month, 3 month, 6 month. On the far right side, we have long-term notes, 7-year, 10-year, 20-year, 30-year. And the ones on the left have higher rates of return than the ones on the right, which is unusual. That's called an inverted yield curve. You would not expect that the longer you borrow the money, the lower rate you pay. You would expect the opposite. So it's an unusual situation. It's an inverted yield curve. And it's been inverted since April of 2022. Analysts are quick to point out that inverted yield curve can be a strong indicator that a recession is pending in the next 6 to 12 months. However, a recession is not a sure thing, as analysts also remind us that sometimes the yield curve inversion does not lead to a recession. Other factors to consider include job and wage growth, business investment, and consumer spending, all of which are strong right now. Money rates and safety. So safety and FDIC insurance comes at a cost, and banks are still averaging low interest rates. According to Barron's, the average bank money market rate on June 26, 2023 were still only 0.32%, and the average 12-month CD rate was 1.7%. Clearly, these are still low returns, and it pays to shop. Our clients can enjoy the convenience of shopping for them and holding their short-term emergency funds in an account with no fees. Prior to yesterday's rate increases, examples include the Schwab Treasury Obligations Money Market Fund, which paid 4.79%, and a JP Morgan Chase 1-year CD, which paid 5.3%. These are various things we've been using for our clients in that no-fee convenience account. Will we have a recession? The oft-discussed and not yet seen recession is not currently affecting equity prices. While many analysts project a recession in coming months, it seems equally many say there will be no recession. We are the proverbial broken record that's saying that no one can tell for sure what will happen, and if so, at what level of severity, nor at what time it will happen. Our process is to plan and prepare for the potential of a recession to happen at any time, rather than trying to predict it. Part of that plan includes maintaining adequate financial liquidity. This means making sure you can meet all of your current financial obligations, your credit card bills, your utilities, etc., and prepare for any large future cash obligations like a wedding or purchasing a new vehicle. Of course, concerning, scary, if you will, financial events will periodically happen. We all understand that. At those times, it can be best to avoid too much exposure to the news. Much of today's media reporting is really not there to inform the viewer, but rather to incite fear in the viewer. This can create undue anxiety and cause investors to make emotionally charged decisions, which is not how smart financial decisions are made. So investors need to be prepared. Proceed with caution. We stand by our belief that investing in equities is a long-term commitment, and investing in equities is the best way to make money in the long term. Investors, however, must plan to continue facing a challenging market environment. Maintaining discipline, practicing patience, and proceeding with prudent caution are the keys to reaching your financial goals. Multiple factors remain key players in the short-term direction of equity markets, especially interest rates and a potential U.S. and global recession. As your financial professional, we are committed to keeping you apprised of any changes in activity that could directly affect you, in your unique situation. Once again, stay the course. Seasoned investors understand that equities are long-term investments, that long-term investing is not linear, requires patience and discipline. I'm sure you're kind of tired of hearing me say that, unfortunately. I guess it's a bit like going to the priest. You don't necessarily want to hear everything he's telling you, but it's all good for you. So staying the course and maintaining the consistency of a well-devised, long-term focused plan has historically served investors and our clients very well. Here's a couple things to remember. It's possible we will see another interest rate in 2023. Federal Reserve raised rates yesterday and indicated they could possibly raise rates again. We're hoping and thinking they may not, but they could. The cost of borrowing is elevated. So if you have any debt, if you own any credit card debt, you own any interest that has adjusted upward, you should pay it off. In this current high interest rate environment, those are becoming very expensive. And don't borrow any more money if you can avoid it. You should review your income producing accounts to ensure your earnings are competitive. Are you holding cash in the bank that's not earning the kind of interest that it should? Remember that a well-balanced portfolio should be designed to have some resilience in times of volatility. And certainly that is something that we do for you in your portfolios. Oops, I jumped ahead here. Okay, remember that I mentioned that already. Of course, patience and remain focused on your personal long-term goals. Inflation is still high. Revisit your budget. Determine what is necessary versus discretionary. If you can avoid spending something, then those costs are not going up. So that's a good thing. Should a recession happen, we want you to be prepared. Having a solid investment strategy, an integral part of a well-devised, holistic financial plan. We help you create a plan customized for your unique situation, including understanding how you will react to the ups and downs. We consider many variables, including your time horizon, tax implication, liquidity needs, risk tolerance, and personal objectives. Personal prudent caution should be the principal notion for investors. And as always, we are here for you. As stewards of your wealth, we are here to help you pursue your goals. If you'd like to revisit your financial plan or discuss any concerns, have any ideas, please call our office, call me, call Dan, call Tim, call any of us, or bring it up at your next scheduled meeting. We're happy to help you and answer those questions. And lastly, we appreciate you. We so enjoy working with all of you. And really, we appreciate the privilege of helping you on your financial journey. One of our goals is to help more people just like you. The best compliment we get is a referral, and many of our best clients were referred to us by our existing clients. So if you know anyone who might benefit from our services, let us add them to our distribution list to receive our newsletters and invitations to our presentations. Again, thank you so much for your business. One of our primary goals is to keep clients informed, and we appreciate your watching update. And please call us if you have any questions.